When you start looking at the real rate of inflation, it's very, very high, and it's extremely high compared to what we're paying in interest. Our interest that we're paying is still single digits. Because of that single digit interest, you get to see that as you're paying it back, you actually give them less and less every single month. If you're just at a flat 8% inflation, which we've been above that since the 90s, actually since the 80s, when you look at the real rate of inflation, a flat 8% means that your dollar is losing 0.666% of its buying power every single month.
Wow.
So as you're paying something back, you'll start to see at today's interest rates, you'll actually pay less than what you borrowed.
Hey everybody, Flip and Dani here. Welcome to another episode of The Freedom Show.
We're super excited to be back. If you are coming back because you heard last week's and you were like, I can't wait for part 2 to be released, well then welcome back, because we're super excited to be sharing Aaron with you again today.
Yep.
But before we get into that episode, we wanted to talk to you a little bit about annual planning and preparing for 2024, because this is the holiday season.
That's right.
A holiday season.
Oh, geez. She's been listening to Christmas music since Halloween.
Yes. Yeah. As soon as Halloween. Yeah.
Yep.
And that was actually thanks to you. You actually you put lights around the house and everything. And I was like, yes, it's Christmas time.
That's right.
So exciting.
But we don't beat our team in the Philippines, because they actually decorated on September 1st.
Yes. Did you know that in the Philippines, they spent 4 months, right? They start in September.
September 1st.
And so September, October, November, 4 months of Christmas. And here in the States, we get yelled at if we have decorations up before Thanksgiving. That's so funny. Oh my goodness. So annual planning. I really love planning, because many times we get caught up in working in the business instead of on the business, right? And when planning comes around, it's the opportunity to take a little step back, elevate yourself, way, way, way up here, and look down and go, oh, we should probably fix that.
Yeah, we need to fix that part. Right? Yeah, that one right there. Yep.
Yep. And I was just, we had a post we have this channel in our Google chat called Core Leaders. And it's really kind of the leadership team within our company. And we were talking about bandwidth and how that it seems to be probably one of our biggest problems right now, is that everybody is just at the, very, very limits of what they can handle in terms of bandwidth. And so, I said, okay, well, here's an exercise that we can all do. And I actually started it with Caitlin, our marketing director. So I didn't use Tiffany. Hi, Tiffany. I'm talking about Caitlin right now. So,
hey, I heard Caitlin swear the other day. Just letting you know. I'm letting everybody know.
Oh man, Caitlin's been outed on a podcast. So I was talking to Caitlin, and she's the marketing director, and she's over all of the companies. And so what's on her plate is insane. And we've really grown her team like heavily, because marketing is really one of the most important things that we could be doing here. And it was a foundation builder in 2023 anyway. We really invested a lot of money into building our foundation in 2023. We redid our website. We brought 2 websites and made them one, redesigned our logo. We did all this podcast room, like all of this stuff is brand new. Yep. And the fact that we finally launched season 2 of the Freedom Show is literally because we focused on marketing here in 2023. Right. There was 2 more things that I jumped on, and I'm very impulsive. I'm like, yes, we need that. We're working on it anyway. And this is going to get us there faster. So let's get it. And so I got 2 things, and one thing's actually going to squirrel. It's not squirrel. We're working on it anyway. One thing's actually going to lift the burden a little bit off of one of the team members in the marketing department. And the other thing was a little bit of an addition, but it's going to be more effective in our ability to launch it. So we're launching some courses this year, and we're going to put it on our Go High level and just have the website and the normal desktop course. And I was on this webinar, and they were just like, more people use their phones these days than they do desktops, and it's more advantageous to have things at people's fingertips. It makes it simpler for them. So I'm building an app. I'm not building it. My team's building it. But I put that and I said it, and Caitlin smiles. She's so sweet. She smiles and she's like, oh, and she's happy. At the same time, I can see it in her head going, not another project. I can't do another project. I'm not going to do another project. So I was just like, okay, let's look at what all the projects are, and let's make sure that you've got capacity, and let's like throw some that aren't necessary and put them on Q1 or whatever. Mm-hmm. So you're always having to do these things in business. So it doesn't matter if it's quarterly planning or annual planning. You should always be checking yourself. If you see something that lines up with something that you were doing anyway, and suddenly that becomes a priority over some of the other projects, by all means, you don't have to stick to the script. Just, grab the stuff that isn't as important, dump it down, and then make sure that you're always prioritizing what's most important. So Chris actually mentioned something in the Core Leader channel about the bandwidth. Mm-hmm. And so I said, here's an exercise that I'm working on with Caitlin. I didn't say it to Caitlin this way because I'm actually helping her with this, so I can figure out what we can dump. But I told him, I said, if we could just have all team members write down, what are you doing? Right? What are you doing right now? What are the projects that you're working on? And then if you can write next to them the word revenue, the word customer experience, mm-hmm. or the word critical process development or improvement, critical process improvement. So CPI for critical process improvement, customer experience is CE, and then revenue. If you can write those three words, if something's on your list that has nothing to do with those three things, so for instance, on one of the things on Caitlin's list is swag. Uh-huh. We want to get our swag store up, right? Because we want to have cool shirts and stuff. Right. It's barely revenue because we don't really make money on swag.
Yeah, maybe $1.
Customer experience, it would be fun, but it's not the type of customer experience when we're talking about excellence and really serving our investors better. And then critical process improvement, it definitely doesn't do that. So that got dropped off our list and into Q1. Yep. Even though it would be fun to do, she might throw it back on our list because she has the capacity to do it and it's fun. So it might move back up. But that was the point of the exercise. If it doesn't fall in those three categories, it can get moved. Mm-hmm. But if it's revenue, it is first. Anything you wrote revenue on, you're going to put it at the very, very top of the list. Anything that you wrote customer experience on, you're going to put it third in this scenario, and I'm going to explain why and then where we shift it. For critical process improvement, you're going to put it number 2 because typically a critical process improvement is a bottleneck in the company, which affects revenue. Mm-hmm. And so revenue 1, CPI is number 2 because it has to do with revenue, and it has to do with the customer experience. If it's a bottleneck, it's not only affecting revenue, it's affecting the customers. Customer experience is 3 only because those other 2 had to be put first. Right. But the customer experience, then you have those things, and depending if your job is to really focus on the first 2, you could say, hey, Flip, you actually don't have these first 2 on your list. Can I give you these 3 customer experience pieces? And boom, now it's number 1 priority for you. Right. So now we lifted the customer back into a number 1 seat as far as a priority. So we're going through that process. And I just encourage everybody to go through it, no matter if it's planning stages or not. Those are always important processes. Right. But I just get excited when it comes to this because we really get clarity. Mm-hmm. We put our blinders on just like the horse and we go, this is where we want to go. We fine-tuned it. We know what direction. We put some accountability pieces in place. We know who's responsible for what. We know what they're reporting on every single week. And that type of clarity fuels me.
Yeah, no. And plus it's also make sure that everybody on the team knows exactly what we're doing.
Yes.
In case somebody's like, well, I'm not sure, our quarterly planning that puts everyone back in line, mm-hmm. Because 2-3 months, that's enough to get somebody start straggling over here.
Yes.
So I love it.
Yeah, absolutely. And also I think it really helps new team members too. Oh, right? Yeah. We talked last episode about how hard it is sometimes to make sure that you're conveying the vision that's in your head to mm-hmm. the team and making sure that they understand where the company is going. That's just as important for the investors, right? Yep. Where is the company going? So that 12-part series that we did, that helped communicate that. So we're just getting better and better. And so those are the things that we do, and those are the things that we talk about, and those are the things that we want our investors to know. We want active investors to know, so you can apply. Hey, that's a good idea. Let me go ahead and do this, because we only know what we know now through all the trials and the pain and the suffering that we went through to go, this is how we should do it. I love talking about this type of stuff at the very beginning. So now we're going to dive back into Aaron.
Yes.
So this episode is going into a superpower.
Yes.
Yeah. And we're doing math.
Yes.
And I think
that's what they call it.
And I think last week we said have a calculator ready if you're not in a car.
Yeah, if you're not driving, a calculator would be helpful.
Yeah.
For most.
Yeah.
There's some people out there that could handle the simple calculations that he's going to ask. Not me.
We had some fun with it, though. We're not going to give you any more secrets about what's about to happen. We're just going to let you guys dive in. Here is part 2.
That's right.
Of Aaron Chapman. Enjoy. Let's jump into your superpower. This is really why I wanted to have you on this podcast. Really share what's going on in the market right now. Share your superpower, which is really the finance industry. And you serve investors like ourselves. So you serve our clients. And that's why I'm so excited to introduce you to everybody. So we've already talked about how you got started. So tell us a little bit about how you help investors and what the real estate investor needs to know about today's market right now.
Thank you. The superpower, I don't know if it's really a superpower. I just believe I have the ability to dumb things down to a way that people can understand it. Because what we have in the world between the attorneys and between the people out on Wall Street and the politicians, they take the most simple things and complicate the piss out of it. So it makes it look like we need them. And then when we start to feel like we're starting to get ahead of them a little bit and we don't really need them as bad, they change the rules just so you need them again. They keep manipulating everything and messing with it. So my goal is to help people understand where the real value of things are. And the main thing is understanding where the value in real estate is. We spent the last 12, 13 years mistakenly understanding where value in investing in real estate was. And it was because everybody kept using the cash on cash return metric as the key to understanding whether it's a good property or not a good property. Now, albeit a great metric, if you get great cash on cash return, why would you not? But the problem of it is that ship sailed. Being able to get a stupid cash on cash return, 14, 15% right out of the gate, unachievable. If it is achievable, I guarantee this property that you're buying is going to eat you alive in maintenance because you're underpaying probably for a piece of crap that's going to rent high, but every time you get the person out of it, it's going to cost you a fortune to maintain it and get it rent ready again. And you didn't get any cash on cash. You just look great on paper. So what I explain to people is where the real value is. And that makes you and I are going to have to do some math to be able to illustrate this. So what we're going to, you guys pick amongst you who's going to do the math because we're going to do it together. I'm going to ask the question. You're going to explain the answer. And just know it's simple math and you are prone to get it wrong because your brain sees one thing, but the reality is something else, even though it's simple. And the reason I do it this way is it's going to sync up our minds. And I need the people listening to be able to say, oh, okay, yeah, now I get it. Because if we can't sync their minds up, they'll glaze over it. So I need everybody to check the math here. So we're going to say a person's buying a $200,000 single family residence. They're going to put 20% down. They're going to finance 80%. They're going to get $1,800 a month in rent. And they're going to only get, say, $100 a month in cash flow. And this is a 30-year fixed loan. So where a person needs to focus their energy at is not what's my cash on cash. It's going to be, can I keep this property reasonably rented the entire time I own it? Does it appreciate? And can I raise rents? That's it. Now, we're even going to beat the appreciation up. We're going to beat everything up on these numbers. So here's where the math comes in. If you're buying a $200,000 home, you're putting 20% down. How much are you putting down?
$40,000.
$40,000. Yeah, okay. Everybody check that math. Make sure we all agree. It's 40 grand. Now let's say between the lender fees, appraisals, taxes, insurance, title fees, all this crap, it's very expensive. Let's say it's 10 grand. I'm not saying that's what people pay us. I'm just saying let's do round numbers. It's 10,000. So if you put 40,000 down, now you have 10,000. How much did you invest?
$50,000.
$50,000 invested. That's your money in the deal. How much was the loan amount?
The loan amount was $160,000.
$60,000. A lot of people, you did very, very well. A lot of people like to say 150 because they automatically in their mind, they think I invested 50. They go, it's amazing how often that happens. 160,000. So if we said this is 30-year fixed, if you did your job as the CEO of your real estate investment business, and you keep it reasonably rented the entire time you own it, who pays off the $160,000 loan?
My resident.
The tenants or a group of tenants over 30 years. So let's take 160,000, divide it by 30, and let's see how much they're actually giving you averaged over that 30 years.
I don't have my phone, and I can't do that math in my head. Flip?
Roughly 53,000.
It's 5,300.
5,300. Sorry.
You had just a decimal point off, which I mean, you got that, right? It's $5,333.34 per year is what they're averaging payoff. Now I know there's an amortization table, and it's only gonna be about probably $1,200 to $1,300 first year. I'm talking about an average because we're talking about a 30-year long game. So their average giving you $5,300 a year. Well, what percentage of 50,000, which is your investment, is 5,300?
It is 10%.
Close to 10%.
But yeah, a little over 10%.
0.66%.
Okay.
So we're getting 10.66% increase every single year, averaged over 30 years, correct?
Correct.
Just by having somebody paying off the loan. You're not getting a single dollar of cash put in your pocket. They're just paying off the loan that you got. That right there is increasing your investment by 10.66% averaged over 30 years. Now, I know the first year is going to be probably like 3 or 4%, but we see where the potential is. Now, we put that on the shelf. That right there, we know that growth. Now, we live in an inflationary environment. Do you know what Case Shiller, Black Knight, and CoreLogic said that properties were appreciating in 2023?
No.
They said they're averaging 8.9%. Much higher than what they thought coming into 2023, because everybody knew rates were going to go up. So they thought maybe 5, maybe 6%, 8.9. So let's beat that number way down. Let's say you're only appreciating this $200,000 house by 2.5%. That's a very, very low number and easily achieved number in any market. So what's 2.5% of $200,000?
2.5, 2, oh, 2, 4,
6,000?
5,000? We both gave you different answers. So which one is it?
5,000 was correct.
All right, bam.
Oh man.
And the easiest way to do that, the way I had to do it in my head is, well, if 100 is 2.5% of 100,000, it's $2,500. You just double it, right? So, so 25. So it's $5,000 is what you're gaining every single year. Now it's compounds, right? It's not 5,000 every year. It's 5,000 the first year. Then it's 2.5% of $200,500 or 205,000, right? So you can see how they compounds. But just that first year, that 5,000, what percentage of your 50,000 is that 5,000?
5%. Isn't it 10%?
5,000.
Another 10%.
You got it right.
So look at double-digit percentages, right? Not even factoring the compound that is a 20.6% average increase, not even factoring the compounding effect, right? So when you only take into a consideration compound effect, you're already at 20%, 20% plus. And that's before any cash flow hits your pocket. That's before any tax benefits that hit your pocket, right? So now we talk about the cash flow. We said he was making $100 a month, right, for the first year. But then you get to raise rents. How much are rents going up by year over year right now in your guys' markets?
We predict 3%, but it's actually higher.
Yeah,
it's between 6 and 8, depending upon where you're at. But let's say 3. Let's just use your 3.
Okay.
What's 3% of 1,800? Because that's the rent. We said it was $1,800 a month. What's 3% of 1,800?
480.
It's $56.
We needed our calculator for this episode.
$56. Mike, when people think about it, it's like, oh, it should be going up high. No, it's only $56. Here's the thing about this. You don't get excited about $56. Your landlords don't get excited about $56, and your tenants do not get excited about $56. Like, oh, cool. It only went up by $56. But what did that do to your cash flow? It went from 100 to 156. That's a 56% increase in your cash flow. Look at the compound growth there. People think these small percentages, they look and say, oh, it's only 3% increase in rents. I'm going to go find a different house. No. Can this house stay reasonably rented? Is it one that is in a good area? Is it, what type of grade are we talking about? Is it a C grade house? Is it an A grade house? What type of house is it? Look at all the factors. Just by having somebody stay in there long term, look at that growth. You will, within year 5, 6, or 7, you'll see some massive cash on cash return, but you got to be patient. It's all the other things where the wealth is being created. Now, that's where it gets sexy. Does the lender get to raise the payment on the loan because of inflation?
No, they do
it's
not.
It's a 30-year fixed. That some bitch is locked for the entire 30 years. Here's what's very interesting about that. We live in an inflationary environment. We just talked about that's why we get to raise rents, and that's why appreciation happens on homes. But what happens to the value of the U.S. dollar?
Goes down.
It declines. Here's a way to illustrate how much it has declined. Back in the early 1900s and late 1800s, they used to mint a $20 gold piece. It was a single ounce of gold. It was about 0.98 something percent pure because they had to add some other alloys to make it durable. But that $20 gold piece, you could walk into a department store, get a hat, because hats were a big deal back then, right? You can get the hat, you can get a suit, you get a shirt, a tie, a belt, a pair of shoes, and a pair of socks for that $20 gold piece. You can't walk into a department store and spend $20 for a pair of socks these days. It's more expensive than that, right? Especially decent socks. My socks cost $40, right? Because they're a wool. So because of that, we know that the dollar is completely eroded significantly. But here's what's interesting. You can still get all the things I just said with an ounce of gold. Why? Because an ounce of gold is worth over $2,000. It's not that the gold has gone up in value. It's not that the clothes have gone up in value. It's that the instrument we're exchanging for them has eroded so much in value. So where this is a benefit to everybody listening here is when you lock in a loan and an interest rate and you get all caught up in what are rates doing, think about what the rate of inflation is doing. Inflation is much higher than what they're claiming. They're claiming to be between 4 and 5%. It's closer to about probably 11 to 12 when you really start factoring things in, because they're talking to us what the rate of inflation is in the CPI or consumer price index. It's an index. It's not everything. It's a few things that they monitor, not everything that we spend our money on. When you start looking at the real rate of inflation, it's very, very high, and it's extremely high compared to what we're paying in interest. Our interest that we're paying is still single digits. Because of that single digit interest, you get to see that as you're paying it back, you actually give them less and less every single month. If you're just at a flat 8% inflation, which we've been above that since the 90s, actually since the 80s, when you look at the real rate of inflation, a flat 8% means that your dollar is losing 0.666% of its buying power every single month.
Wow. So
as you're paying somebody back, you'll start to see at today's interest rates, you'll actually pay less than what you borrowed. In this scenario, you pay $160,000 in principal, but in principal and interest, it's be about $402,000 over the life of the loan. That's where everybody's like, oh, I'm going to pay this off early, or I'm going to refinance and try and get this rate down because that's all this interest. But what you don't realize is that the longer you take to pay, the less you actually pay, because that dollar is worth less and less and less. You come to find out you're paying about $152,000 in actual dollar value. So keep your extra cash flow. Don't pay it off any faster, and don't get caught up in the freaking refis. Let me ask you this. Who does it benefit when you refinance?
The bank.
And it benefits the banks. It doesn't benefit you. Everybody thinks it benefits you. Now, if you're pulling cash out to buy more investments, yes, that benefits you. Using somebody else's money to expand your holdings. And did you invest in when you pull cash out of a house, you take all that money and put it into other investments, and let's say you buy 3 houses with what you got on the loan for one, did you put any money up?
No.
You put a single dollar. Every single cent of return is an infinite return because there's no way to calculate it. There's none of your money. That's how rich people get rich. It's all leverage. Now, when you start looking at the benefits for the bank of refinance, everybody's like, how could that benefit the bank? I just dropped my interest rate by 1%. Well, I had a client of mine came to me, had a $120,000 mortgage when he bought this house. He came to refinance it 48 months later. It's the 47th month. And we did the math on it. It's like, dude, you paid almost $37,000 in principal and interest on this over the last 47 months. His new payment was coming due. He was making that payment. So 48 months have gone by. He's paid over $37,000, but only dropped the balance by like $6,500. Look at all that went to interest. Tons of money went to interest. I tried to talk him out of the refinance, but he wouldn't listen to me. When he refinanced that, where does his cost usually go? They go back into the loan, right? So we added back into the loan because he didn't want to come into to the table with any money. It took his balance to within $106 of the original balance. It was $119,000 and change. So he literally reset himself where he was 48 months before, but still paid out over $30,000, like $31,000 in interest, and started that over again. People are being conditioned to refinance every 4 to 5 years. It's been common within our industry. Why? Because you keep people in financial servitude. That's why there's so much front-loaded interest up front, because that's when people are programmed to come in and do that refinance again. We've heard it being said, if it drops at least this much or you get to this point, you should always refinance. That was always being perpetuated by the bank. right? The same way De Beers convinced everybody to spend at least a month's salary on a freaking ring to get married. So it's all marketing. You've been conditioned. And if you keep doing that same pattern as this guy, he would have paid over $180,000 in 20 years, but never moved the needle on his mortgage. Never. Where somebody else could have paid the original payment for the entire 20 years and had it 2/3 paid off.
Wow.
And then could have pulled a ton of equity and bought 5 houses, right? So that's the other thing people don't realize. You're being put into financial servitude when you get caught up in the refinance game.
Yes, that is mind-blowing. And again, something that nobody talks about. You always hear from even your mortgage professionals, for the most part, with the exception of you, Aaron, are talking about refinancing. And correct me if I'm wrong, but they're getting paid to refinance you as well. Yes?
100%. That's why they're talking about it. That is your career, their career path. So very, very recently, there's a lot of people in the mortgage industry that are saying, well, why don't you just take an ARM loan because you get a lower interest rate and then refinance when the rates go down? Well, what I'm explaining to everybody, because I had a big run for about a year there after probably about 6 months. Everybody's saying, can you guys do an ARM? Everybody says I should do an ARM. It's like, why do you think they're saying that? Well, they say, because I can refinance in 5 years. Well, one, you're just setting yourself up to be their future business. And that's exactly what all the leaders in the industry are saying. Sell the ARMs so you have future business, right? Keep track of those clients and market to them in a few years. So that's their future business model and business plan. Secondly, who says the rates are going down?
That's right.
Yeah. Do you guys know the name Charlie Munger?
Yes, sure do.
So he was on I think it was CNBC or MSNBC. I can't remember which one. I think it was Christy Quick that he was being interviewed by. And in that interview, it was earlier this year, he said that we saw 40 years of declining interest rates. They anticipate to see 40 years of increasing interest rates. I had a clip of that on YouTube. I go to that clip now and it's taken down. You can't access that clip anymore. I have spent about 6 hours of going through every edited version of that interview, and it's no longer in there. What's also interesting, I downloaded the interview, what I believe is the interview, and it's been redacted from the transcripts. I can't find it. Why do you think they can't find it? Because they don't want people to know that we could be on a 40-year increase of interest rates. So you don't lock it in now. You wait till the next thing. Now, there's so many people sitting here waiting. Well, I'm just going to wait till the rates go down because they say the rates go down. Well, okay, let's say they do. What do you think house prices are going to do?
They're going to still go up.
Yep, going to keep going up.
Jump, right?
Yep.
It's amazing how many realtors I talk to or I've heard from. It's like, you banks and the damn rates, and they're bitching at us like it's us, right? It's like, well, what about you damn realtors that would tell your client when they want to buy a house that you better come to the table 30 to 50,000 over list just to get in the game? Nobody bitched about raising prices 30 to 50,000 because interest rates were 2.5%. You gave away the benefit of the interest rate in the price of the house. So now we're at an equilibrium where the price of housing is kind of semi-stagnated. They really have an 8.9% increase, but there's some areas that actually have come down a little bit. I'm telling people, you better lock in the price now, because if you're right, let's say Aaron Chapman's wrong and the interest rates do go down, you better have locked it in now because you're going to get screwed hard. And what's really interesting is even though the rates are going up, the cost of housing is not going down. Why is it not going down? What are the hedge funds doing? They're buying the hell out of it. You got BlackRock, you've got Vanguard and State Street are anticipated. This is anticipation. I don't have all the statistics on this. This is anticipation for them to control 60+% of the available single family housing by 2030 to 2035. If they do that, they will have accomplished turning us into a subscription-based economy for the next few generations. Our generation will make it through, but what about our grandkids? I've got a grandkid here at my house today. I've been watching her most of the morning. She's not going to have a shot at this if we don't do something now. You want to talk about freedom family investments? The freedom for the family should be buying investment real estate now, because it's not going to be available later. I just closed on 2 houses in Missouri because I have 2 kids moving out there, both like 5-bedroom homes for a couple $100,000. Our family trust paid cash. I put liens on it. I'm going to refinance, pull the cash back out of it, put it back in my accounts to keep expanding our holdings. But that's the only way they got a shot at this, is to rent from the trust. And then the trust is going to keep growing it and keep growing it for the future generations. Because if we don't do that, they're going to be taken advantage of. And it's my opinion, again, my opinion, because I don't know the future, if we're not doing this now, we're going to end up being the ones paying the subscriptions, not offering the subscriptions.
That's right. That's right. Wow, that's so powerful. And to tie back into Charlie Munger, I just want for everybody in the audience that does not know who Charlie Munger is, it's Warren Buffett's partner. And that's something that I learned a few years ago. Somebody I was on the phone with talking about similar things as you are talking about today, Aaron. I was like, have you been following Charlie Munger? If you're not following him, you need to write his name down and start listening to what he has to say. So gosh, that is so powerful.
And another thing, just speaking of Charlie and Warren said, you can Google this. He said that the 30-year fix is the greatest financial instrument in history because it's a one-way bet, right? If you're wrong, let's say the rates go down, you just refinance. Who gives a shit? If you want to refinance, I don't think you should, but if you want to, you can. But if you're right and they keep going up, and if I'm right and if Charlie's right, you just protect yourself from some heavy financial devastation. I was listening, I've got a guy on my team named Scotty Bear. He helps people on the interest rates and figures out what's the best one for you in the available market. And he had CNBC in the background and they were talking. And there was a comment that was made. It was interesting that housing inventory is very, very, very low and very lean, but they anticipate when some of these ARMs come due, the 5 years and 10 years and ARMs, that we're going to see a flood of inventory because people are not going to be able to make their payments because the rates are going to jump that high. It was a quick little blurb, and only somebody like myself would catch it, but that's what they're talking about. So if you think they're coming down, think again. The other thing that a person needs to have is the numbers I gave you earlier about what's happening with the dollar. You don't have to try and figure that on your own. You can go to your app store right now and search for the QJO investment tool. That's my app. And that app will actually show you and run those numbers for you, the time value of money. You're not going to know how to use it, so you shoot me a text, and I'm just going to give you guys my number. Just text me, 602-291-3357. Again, that's 602-291-3357. Say, send me you can schedule an appointment with me. I'll have my assistant, Bree, but you text me. I'll have her set it up and ask for the videos on how to use the app. And it's called, again, the QJO investment tool, which stands for the Quit Jerking Off Investment Tool, because that's what you're doing when you're trying to hunt for the rates, or you're trying to wait for the market to get better. You're just wasting time on something of zero value.
Bam! I love that. Okay, so you are listening to The Freedom Show with Flip and Dani, and our guest is Aaron Chapman. We are going to be right back after this short commercial break.
Add new income streams to your financial statement. Freedom Family Investments can help. Own property and get paid rent. Join funds and get paid interest. Wealth is well-being. Own your own future. Freedom Family Investments. Get more time to focus on what matters. Learn which investing path is for you, where to start, and who to trust. Visit freedomfamilyinvestments.com.
Don't forget to leave a review so we know how we're doing and what you guys are enjoying.
All right, and welcome back to The Freedom Show with Flip and Dani. Our guest is Aaron Chapman. We are going to do one of our favorite parts of the show. This is real quick with Flip, but before we get into that, Aaron, I just want to say thank you. The power that you come and the value that you provided in this episode of why people should not be sitting on their hands right now, and why they should be connecting with people like you who can teach and educate them on the importance of the investments, things that you're sharing that they're not hearing from anybody else. It just blows me away. And I am so glad that you're part of our network. I'm so glad that you help our clients. And I hope everybody downloads that app. And we're going to put it in our show notes. And I hope that you text Aaron, because he is a vault of information that, again, Flip and I invited into our company to tell all of our, team. And lo and behold, our team already had connected with Aaron. So super, super excited. And before we're going to recap some of that again, so you guys know how to get in touch with Aaron. But Flip, you ready to jump into this real quick with Flip?
We've been doing this for a number of episodes now. I don't think this has been more anticlimactic for me to jump in and do this segment. I feel like I should have like a clown hat on and a little noisemaker. Okay. So now we're gonna get to something completely useless. All right. All right. So we call this real quick with Flip. Again, I told you before we started recording, so it's going to be like this, that, or the other. I'm going to give you two options. You can choose one of them, but if you don't like either one of them, then you can choose another. And so are you ready?
All right, wait, I don't know how quick I'm going to be because usually my quickness is on other things. So we'll see what happens.
Yeah. You know, we call this real quick it's not quick at all.
Just have fun.
Yeah. All right. So the first one, I'm gonna set you up with a nice lob here. Country music or rock and roll?
Let's go with rock, but there is a lot of country that is, man, it's a lot of my history, man. You don't cattle ranch without listening to that kind of stuff. So there's a lot of good memories to that, but it's always going to be rock.
Nice. All right. We can't see it in your screen here, but messy desk or a clean desk?
It's clean where the stuff needs to be worked on, but I do have stuff stacked over here. So it's actually cleaner than normal.
There you go. So are you a morning person or a night owl?
I'm a morning. I'm 4:30 a.m. every single day.
Yes,
yep. Us too. Well, our bulldogs are the reason I don't set an alarm. Okay, so what would you rather have, a time machine or a magic wand?
Probably a time machine. I would imagine the wand would probably act as a time machine, so maybe the wand, but I would say a time machine because there's a lot of things in history I want to see. And I want to see for myself because I think people have really, they have messed with it and changed it, and we don't know the reality. Yes. I would like to know what the reality was.
The truth with a capital T.
Yep. All right. Comedy movie or scary movie?
Neither. I don't. Comedy anymore is stupid, and scaries they get too close to the spiritual, and I don't want to mess with that crap, right? I've been to a few of those. Sometimes scary movies are funny though, because if you're in the theater with the right people, you just start watching them, and it's awesome. Some of the biggest, meanest looking sumbitches just crawling out of there, and they want out. Especially these devil style ones, these satanic ones. I hate those things. But me, I'm more of an action movie guy. That's it. Yep. And I'll laugh my head off at action movies. Have somebody get their head chopped off, and I'm laughing.
Yep. I think we're both the same. I think the last comedy we saw was the Ricky Bobby.
If you're not first, you're last.
That's right. Yeah. All right. Football or baseball?
Again, I'm in neither on that one. I haven't watched either. It's so stinking long. Last time I sat through a full football game, other than Power Room, we did the Raiders, was Super Bowl 23. And wow. I just don't attend any games because it's so much time wasted. It's crazy to think that a person goes to a game or they got to sit up and watch it. It's gone. And what do you have? You're either frustrated or happy, but for what? You didn't do a damn thing. Right. So what are you frustrated for? And what are you happy for? You did nothing. And it's amazing how many people fight because they have somebody's freaking logo on their shirt. Why are these guys fighting? Who gives a damn? Right. So it's a very interesting dynamic to me to watch all that kind of stuff. I just don't get it.
And for those of you that are listening, for quick reference, he said Super Bowl 23. I think right now we're in Super Bowl 50 something. So just to give you an idea
of how long it's been.
How many years ago that was. Yeah.
If I'm playing them though, I'd rather play football. I loved playing football. It was a blast. I played defense. I was a headhunter of quarterbacks, man. I was a defensive end. I loved it.
I love it.
Okay. So would you rather live in 1969 or 2069?
Probably 1969, because I have a 1967 GTO sitting out here, and that was the era for cars, man. That was just late 60s. There was no better time in the world for being a gearhead than in the late 60s, in my opinion.
Yep, I met somebody the other day who's got a 1972 Chevy Nova. Just, love it. That's a car. Just let you know.
Yep.
Okay.
Yep.
All right. Pineapple pizza or candy corn?
Pineapple pizza all day long. I'll do the pineapple with pepperoni on that thing. Candy corn to me is one of the nastiest things the world has ever produced.
And again, I'm sorry, Tiffany. No one has yet to pick candy corn.
It's 0 for guests.
Yep.
Candy corn.
I'm glad there's people that eat that crap because they're the ones that leave my pineapple pizza alone. Maybe, who knows?
Yeah. There you go.
Yeah. I put this one in here because I thought this would be fun. Do you rather shop online or shop in store?
Online person because I don't have the time for store. I would like to be in the store. I'd like to see it and see what I'm getting and make sure I'm getting what I want. But it's a time thing anymore. I'm so engaged with something else that I can click a button much faster. I can drive and deal with whatever. What also sucks is when home improvement stuff, right? How many times you got to go back and forth to the Home Depot or Lowe's or wherever it is or Ace Hardware to do the same project because you keep missing crap. It's amazing. I just hate shopping altogether. How about that? Just shit should just appear.
That'd be a nun.
I am with you.
Got it. All right. Well, you just mentioned the 1967 GTO outside. So last question, speeding ticket or parking ticket?
Probably speeding ticket because you're opening up that GTO, right?
Yep.
And I did get pulled over for speeding in that one time. I did something crazy, just boiled smoke out of the thing, was hauling ass. And I had to pull into my parking lot at work, and up pulls a cop, and he blocked me in. And I had my boss's son with me, and he comes over and raps on my window. I'm like, crap. He rolls down the window and goes, dude, he goes, I'm going to have one question for you. He goes, why are you driving like that? I'm like, it's a 67 GTO, bro. How would you drive it? And he handed me back my thing, goes, I'd slow it down. And he goes, but I like the answer, and he left.
Nice.
You can get away with stuff. It's amazing how much you can get away with when you have the car to do it. If I was in a Honda Civic doing that shit, he would have probably cuffed me.
I would have cuffed you.
I love it. So, Aaron, give one quick recap on why people should be buying real estate today in today's market, despite inflation and interest rate. Just one or two sentences for those people who listened to this podcast and went, wow, that was a bunch of amazing, valuable information. Can Aaron sum that up for me so they get off their hands and give you a call?
The two things you just mentioned are inflation and interest rates is the reason why you should be buying investment real estate right now, because inflation will continue to keep going up and interest rates are going to continue to go up. That's just the way it is. And if they go down, you have another play. You can always refinance, but I don't know that we're going to have that option. But we do know housing is going to keep going up. There's a massive shortage in inventory. Anybody that says, well, we could go through the 2008 again. No, we're not. That was an enormous amount of inventory and not enough demand. We have the exact inverse. People are not getting, people are not able to get into housing, period. And if you don't start doing it now, your grandchildren will not have a shot at it. You are the hope of your future. You want to leave a legacy? Quit thinking it's money. It's education and it's assets. Those two things. Educate your family, get the damn assets, and educate them on how to use the assets. And you need to look at the infinite banking strategy. You need to look at how to utilize family trust to put engage your whole family in the process. And if you need to understand how to do that, you freaking call me. And I told you, 602-291-3357. Just text me or go to aaronchapman.com. But get us connected up. You will get on my calendar. Bree will sync us up and I'll explain it all. You're not going at this alone. That's the other thing. Never ever think you have to do this by yourself, because you do, you're going to lose. This is not a solo sport. This is a team sport, and you got to be careful with people you're putting on our team. There's a lot of predators out there. My industry is full of them. I don't give a damn where you go. Most of them don't understand investment real estate. Most of them don't do investment real estate, and nobody gives a damn what investment real estate you're buying. They just want to close the deal, and they'll back you into a corner financially if they can.
Yes. Bam. Boom. You did it. So everyone, this is why we're bringing our network onto the show, because of value like Aaron Chapman just brought. So give him a call, download his app, utilize this resource. He is here for you. We are so excited that we had you on the show today, Aaron. Thank you so much for your time. I know we went long, but it was freaking worth it. So thank you so much. And everybody else, we are going to see you next Wednesday.
Bye. Oh, wow. Okay. So I am horrible at math in my head. That's all I have to say.
That was fun.
Yeah.
I was thinking.
Is it basic addition? No? Then I need a calculator. Somebody help me, please.
And the funny thing is that like we've seen him on stage go through this exercise. We've seen him with our team go through this exercise, and we didn't think to bring a calculator up to the podcast room because I didn't realize he was going to do this on the podcast too.
Yeah.
And boy, oh boy. So man, that was just a powerful episode. There's a reason why he's in our network. There's a reason why on these podcast episodes, we are introducing you to our network. Mm-hmm. For those of you who have been sitting on your hands because of the high inflationary environment, because of high interest rates, because of materials and all the other things that are happening in the real estate world and in the economy these days, he just gave you all of the reasons to get off your freaking hands and call him because of how real estate is such a powerful wealth builder and how right now is still a great time to buy real estate. Mm-hmm. I saw something on social media the other day and I sent it to the team and I said, hey, you need to fact check this and then send it out to our audience, because it was literally somebody who went back and said, hey, the last time we were at this interest rate was X, and it was like the 8s or something like that. We were at this. And for all the people at that point in time that were waiting for interest rate to go down, they would have waited like 14 years, mm-hmm. in which time the housing prices quadrupled. in 14 years, but people were scared. If they were scared of 8 and they were waiting to get back down to 7, 6, 5, 4, whatever it was, then they just sat on their hands. And meanwhile, everybody else that jumped in was actually building wealth, just simply through appreciation, but maybe through cash flow too.
That's right.
So there is so many ways to build wealth through real estate. Cash flow is not the only thing. And that's why Aaron went into don't look at cash on cash. Yes, it is a way to like view the properties. And for some of you, that's going to be a metric to look at. But right now in this environment, as interest rates are rising, that is not the only metric to be looking for. And we in Ohio like to say, don't count on appreciation. You're always going to look at cash flow. We still say that.
Yep.
We still try our very best to get to the 1% rule. It is not always possible. And it doesn't matter. You don't have to have 1% rule in order to buy a property. Because there was something that we were really surprised about. You were comping a property on a street. Go ahead and tell that story.
Yeah. Somebody was asking me about a property, and I'm like, oh, I know that street. Well, we bought a property on there just a couple of years ago, and I thought it was 2 years ago. It was 5 years ago. And so then I went, wow, let me look into this property. And I was like, holy smokes, the values on the street are really high. And I'm like, wow, we didn't sell it to him for that high. What did we sell it for? And I had to look back at the data, and I think we sold it to him for $79,900. And it was now worth like close to 140 or over 140. We don't sell by appreciation, but man, that's sure sweet.
Yeah. I was like, would somebody call that owner and just tell them their house doubled?
Yeah, their house almost doubled in value.
We tell them, don't count on appreciation. Yep. Oh, by the way, but your house just doubled. Yeah. So there is appreciation in Ohio, folks. But we just say don't count on it, right?
What's that? Slow and steady wins the race. That's the appreciation in Ohio.
Yeah, that's right. But we still don't have the swing. So that incredible example of appreciation, we don't have the swings of Arizona, of California, sometimes Florida, not as much but we love the Dayton and Cincinnati market because of that. And so Aaron was really, really hitting home today to start looking at the right numbers, like shift your mindset, because I can't tell you how many people that we have talked to that are predicting the interest rates will not go down at all for years to come. Like, this is the new environment. And this is not that scary. We've been in this environment before. We've had high interest rates like this before. We all just got spoiled. So I really want to encourage you. Real estate is one of the biggest wealth builders that there is. So if you have questions about this, if you're still unsure about this, Aaron gave you his phone number. Dial that phone number, text that phone number, get on the phone with him, because he will individually talk to you about your situation and help you understand the ways in which you can achieve wealth through real estate, even in today's market. And he'll show you what numbers actually matter. So again, that was a powerful member of our network brought to you guys. That's why we're doing the Freedom Show. I just loved those episodes. And I'm super excited when we do like these long ones and we get to split it in two. It's a little bit more fun for me. I don't even know why. It's like this anticipation of the second half, and that they were so good that we sat here and talked for an hour.
Yes.
So one thing that I want to hit right before we go is master notes. So we're getting close to the end of the year. Last episode, I talked to you about cottonwood syndication and about tax benefits and how powerful those are. At the point of this episode releasing, I am guessing we have probably closed that particular syndication down. We have taken the tax benefits ourselves if it didn't get backfilled. So because we're recording this early, feel free to call and ask just in case I'm wrong. But I want to talk about master notes. We fully intend on keeping it open through the end of the year. So even by the time this one airs, you will be able to take part in the master note program. It is one of our most popular programs. It's for non-accredited investors and accredited investors. You're going to get anywhere from 10 to 12% interest. It's a 5-year auto renewable note. So it'll automatically renew if you don't tell us, hey, Flip and Dani, CJ and Ben, we'd like to take our money out. You can do that at any point in time, and you can cash out at any year. So in the note, it's going to tell you, hey, give us notice by this time, so that depending on where your funds are being used, we can make sure we can pull it back out and get those funds over to you. So feel free to call CJ and Ben, go to chatwithfreedom.com, ask them about the Master Note program, ask them about any other opportunities we do have available. There's a lot we have launching in 2024. I almost said 2023. As we close out 2023, we're super excited about everything that we have going on in 2024. We're glad that you're a part of our world, and we're super excited to be able to share new things with you. Anything else, Flip?
I know. I think that wraps it up for the year.
All right. So happy 2023. I'm not even sure exactly when this is going, but this might have been the last episode before 2024. If it is, Happy New Year. Hope you had a great Christmas, whatever holidays are happening right now. Hope it was awesome. And we're going to see you next Wednesday.
Bye. Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions and information on the show are not guaranteed. All investment strategies have the potential for profit or loss.